Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 31, 2020. Please see our disclaimer for important information. In our first chart of the week, we go back to our COVID tracker, which just simply want to highlight the fact that we're still seeing continued positive trends in that blue line, which represents daily new 7-day moving average positive test for COVID, as well as that moving average, 7-day moving average amber line for daily deaths. And obviously we want to continue to see progress in the days, weeks, and months here coming ahead. This is a chart from the American Enterprise Institute showing trends in certain areas of the country. Now, obviously, we had a huge spike in cases in some of the Sun Belt states, which are depicted in kind of that yellowish area: Arizona, California, Texas, Georgia, Florida, and Louisiana. And you can see those numbers are going down after having crested right about the beginning of July. And we're seeing progress nationwide. And obviously, we're seeing kind of a muting out of new cases in kind of the upper east category, but we're seeing a little bit of a spike in the remaining states, and particularly in the Midwest. So while most of the areas of the country are going down, we're seeing a little bit of increase in certain parts of the country. So I've got a couple more charts from COVIDtracking.com as reported by First Trust in their weekly updates. So these are hospitalizations. Again, we go back and on the left-hand side, we look at some of these high impact areas during the summer, the Sun Belt states that have these the spike in cases, and we've seen a tremendous decrease in the hospitalization rate and occupancy from their peak levels. And you can see, like Arizona, for instance, the hospitalization rate down from their peak is down 72%. Here in Texas, it's down 55%. Nationwide, it's down about 36%. So good news there. And on the right-hand side from COVIDtracking.com, we see the COVID case fatality rate. And that's been fairly consistent at or near 2% here from July. So with all the publication about new positive cases, I mean, the fatality case rate is still fairly muted. So before we move on to economic and market related data, we have a couple more slides on COVID-19. And this is just a cross-sectional analysis of COVID related deaths as a percent of total deaths. And not to sound too morbid or to dwell on the topic of deaths related to COVID-19, all we're doing here is just providing some perspective. And as you can see by an age cohort, you can see very few overall deaths. As you might imagine, as you get into the older cohorts, you tend to see more overall deaths. But the key thing is to look at the COVID-related deaths. And just for instance, we're talking about opening schools right now. And so that age 15 to 24 cohort is particularly important to all of us right now. And so you can see that basically from the 1st of February through August 22nd, there have been a total of 18,594 deaths from all causes during that time frame. And during that time frame, we've only seen 280 COVID-related deaths. And so obviously the COVID-related deaths as a percent of the total is very, very small, just slightly, significantly above, only slightly and non-significantly above zero, I should say. But obviously, as you get into the older cohorts, you can see that obviously total deaths have risen, as well as COVID-related deaths have risen in aggregate terms. But interestingly enough, the percent of total deaths attributable to COVID-19, when you get really past the 55 to 64 age cohort, it's really kind of stuck at or near 10%. So basically 10% of overall deaths between February and third week of August were attributable to COVID-19. Deaths by age and versus a percent of the population. Again, very low when you look at the younger ages, much higher as you get older. We've shown this slide before. It's been a little while, but basically that 31.5% of COVID-related deaths are people that are in that 85 years old and over category, and that we have an aging population, but we still have a large part of the population that's somewhere between that age 5 to age 55, and as you can see, the percent of total COVID-related deaths are relatively low, and they really begin to spike when you get to that age 55 to 64 range. Okay, now moving on to our high frequency data, and this is published weekly, compiled weekly by First Trust. It's published by a litany of sources, but as you can see that by and large we've had a positive trend with lone exception, a couple of exceptions here. One is supply of motor gasoline, and this number is a little bit volatile. That number was down at least over the last week, and this is through August 27th, incidentally, but over the last week was down about 3%. TSA checkpoint data has been trending very positively, but kind of mitigated a little bit over the last month, is down about 4.6. As you can see, most of the other indicators are positive. Hotel RevPAR, which is revenue per available room, is up. Daily rates are up. Occupancy is up. And then other trade-related data, which we have coming up. Rail car traffic up 3%. Steel production up 2.5%. So jobless claims, they did spike up a little bit above 1 million when we have seen several weeks below 1 million. Nothing to get overly concerned about, but as you'll see a little bit later in the chart, Pat, we're spending a little bit more time, I'd say, worried about or just watching the pace of hiring within the small company cohort. But high frequency data, on balance, positive. The chart that picked up in some of the reading of Daily Shot publication, not too surprisingly, you see people kind of shunning mass transit in favor of individual transport, whether it's walking or driving. Mass transit is not recovering as fast as some of the other modes. This is consumer confidence, and we know that confidence has been shaken for a lot of different reasons, but I wanted to point something out moving from the left to the right. Now, obviously, we know that consumer confidence is an index, and it's published by the Conference Board, and they break this out into different age cohorts. So what you see on the left is the aggregate number, and we know that it's been weak, and we've kind of been struggling with it. We're getting a little bit of conflicting data out of the consumer, which we'll get to over the next several slides. But interestingly enough, on the right, and if you pay attention to the difference in the blue and the green lines, you can see that the blue line represents age of household where the head of the household is under the age of 35, and confidence level for that cohort, which is really the millennial, is gone down. But we've seen some really positive trends in the millennials. In fact, the millennials now account for almost half of new mortgages these days, but their confidence level, interestingly enough, is lower than that of the older cohort. And I want to show this to kind of contrast what the consumer's thinking and what CEOs are thinking. So, CEO confidence, again, this is measured by the Conference Board. So keeping with the, statistical provider here, consumer confidence is down rather significantly, but CEO confidence has actually picked up and has remained fairly steadfast, because CEOs tend to take a longer term view of their conditions relative to the consumer, which is more, looking, 2 feet in front of their face and analyzing what they see. So this is where we get into some of this interesting dynamic with regard to the consumer. So this is a gauge of, it's a Bloomberg produced gauge of consumer sentiment on buying conditions. So this is not necessarily spending per se, but it's just buying conditions. And good news here, against that kind of weak backdrop of sentiment, at least buying conditions are really back to where they were in April. Now they're still down well below their levels at the beginning of the year, but it's trending in the right direction. And so getting back to this notion of, well, what happens when this stimulus money goes away? And we know that a lot of the stimulus money received by higher income earners was saved, and most of the spending boost that we got during the peak COVID months was related to lower income cohorts that were spending that stimulus and driving economic benefit there. Now we know that spending overall is down, but interestingly enough, once that $600 extra stipend was rolled off the books when at the end of July, that we really haven't seen that much of a change in card spending. And this is data from JP Morgan Chase on cards that are issued by them to spenders. And so they break out that into different low unemployment and high unemployment states. And really there's not much of an impact, frankly. So, consumers may have low sentiment, but their spending habits suggest that they're still out there using their cards. Now we see here that retail spending, again, goes back to the adage of what consumers do, not necessarily what they say. And so we see here that retail spending, as depicted here from Census Bureau data, as well as analytics that are provided by Haver Analytics and an additional source attribution to Barclays, that retail spending has recovered, I should say, back to levels that we saw a little bit earlier. But food and beverages, bars, we know that are still shut down or curtailed significantly, are still facing some challenges. So this is a chart that kind of gets us into what would people do if they got additional stimulus money. And this is kind of at the heart of the debate. And it's a relatively partisan debate. So, does it really help the consumer? Will they put it to work? And this kind of, I want to focus less on the distinctions between men and women, although they are kind of interesting. With regard to the one on the bottom, which is saving money, very large gap there. But just kind of the aggregate responses, if you will. So and that's really what I take away from this slide is if we reinstated a stimulus payment to people, what would they do with it? And I think what we see here is that a large number of them would simply save it. So what we want, obviously to do with stimulus money is to stimulate the economy, and that's the whole point of calling it a stimulus payment. But interestingly enough, we've got a lot of people that would actually save it. Now we get into some economic data. This is the Institute for Supply Management index, which is in that blue line, and the red line represents regional surveys of Federal Reserve branches around the country. And this number, as you might imagine, because they're surveying a lot of the same companies, it's going to have a really tight relationship, which you can clearly see here. Good news, and the key takeaway here is that number is perking up. So we see regional manufacturing surveys, which again, manufacturing accounts for less than 15% of the total economy. But when you see the disruptions that we had in supply chains and things like that related to COVID, that it's good to see this number positive and trending in the right direction. Now we get back into global trade. Another good feel-good point here is that we've got, even though the 3-month rolling change in global trade still is weak, it hasn't really brought in to bear the latest data point that we're seeing in trade. month over month is up. So that white line will begin to trend up here next month. And again, another positive data point with regard to global trade. Now, as we get closer to the election, we're going to be talking a lot more about China and the negative rhetoric. And we know that that negative rhetoric is shared by both sides of the aisle. But this is kind of an interesting observation here from ANZ Research, which shows us that against the backdrop of world export volume year over year, which we know is negative to the tune of, call it almost 25%, that despite that, China's share of world exports has been fairly steady over a number of years, and frankly hasn't been impacted that much by what we've seen in COVID. That number is still around 13.25%, of total world exports. Now, continuing on with China before moving on, this is just something that came from the Pew Research Center, which shows that as we go, and this is probably not tied specifically to the election, but as you can see that the negative or unfavorable opinion of China continues to go up, and especially amongst the older generation. You can see the 18 to 29, I mean, all cohorts of age are going up, but particularly the older generation, which I think is going to have some really strong implications even after the election on our approach to China, whether we're going to play offense against China and be more tariff driven, or we're going to play more defense and try to do more to protect our intellectual property and be much more protective of that going forward. So I want to talk just ever so briefly about real estate, and in particular residential real estate. So this is data related to single family homes, and I can't underscore how really good this data is. And if there's one area of the economy that we can all look at and feel really good about, it's residential real estate, notwithstanding the fact that lumber prices are up 100% year over year, because partly due to this. But these are good numbers. And if you look at the trend line, a lot of messy lines on these two charts here, but on the left, this represents new single family houses sold. And you can see that very solid blue line, that represents year to date here in 2020. And even though we had a little bit of a dip, as one might expect in March, April, that number has really rebounded over the last several months. And at the same time, on the right-hand side, you can see single-family inventory. Now, this doesn't. This represents kind of a national view. So I want to caution that it's. There are regions that are going to be different in the way that they're responding to this. But clearly, the residential real estate market is doing well. Higher prices, which are not reflected here, but we know prices are up. This is total volume, so volumes are up and inventories are down. So that will continue to bode well for home price and sales. Now, when we look at mortgages, and we know mortgage volume with interest rates being low has really perked up, and but we know that there's been stress on lower income folks, and we know that there's a much higher percentage of people paying mortgages that are struggling with those mortgages, and that's what this graphic from Moody's Analytics captures. That we have this represents the percent of 30 days or more past due mortgages, and we can see that number has really spiked, and this could cause a little bit of an issue with regard to credit spreads and things like that tied to residential mortgage pools and mortgage-backed securities because of this pronounced increase. And you can see here that when you look at specifically FHA and VA mortgages, that the delinquency rate is actually above where it was back in 2009, which is pretty interesting. The total mortgage pool hasn't quite reached those levels yet, but it is trending in the wrong direction, and we'll need to watch this. So this is what I was talking about with regard to small business employment, and this is from Pantheon Macroeconomics, And it really, what it shows you is that we just haven't really had a lot of momentum in small business hiring. In fact, it's kind of like easing off a little bit in terms of not only the moving averages, but the, just the aggregate levels. And, the percentage change is just not moving in the direction that we had hoped. And this is, really the lifeblood and the backbone of our economy, that small businesses account for almost half of total employment. So it'll be really important to turn this around, and there's going to have to be levers to incentivize people to hire, incentivize people to start new businesses, and we know new business formation is flagging right now. And so if we're going to be confident in our assessment of an economic recovery next year, we're going to have to see this, even this modest decline here, attenuate somewhat and go positive and move in the right direction. Now we get into some of the more investment characteristics, and I just want to kind of circle back to gold for a second. And obviously there have been a lot of gold bugs that have come out of the woodwork. We can clearly see that on the right-hand side, because if you go back to December of last year, we had 63 billion committed to these 5 gold-backed ETFs, which are exchange-traded funds, which trade on the exchange, obviously. And then if you go to August, I mean, that number's almost double. So we've had a lot of money flows, positive money flows into gold. That's helped to drive gold on the CME, the Chicago Mercantile Exchange. That contract has gone up. And then we've seen a little bit of turbulence, but it's still holding steady to its trend line dating back to March. So just an update there. Let's start talking about S&P 500. This is the price to earnings ratio based on next year earnings expectations. So it's kind of looking ahead over the next, not just the next 12 months, but really the next 15 months, because this is kind of an assessment of based on January through December 2021. And you can see that that's spiked as high as it's been since before the tech bubble at the beginning of the century. So we're at extreme levels in terms of estimated valuation. I think the jury's still out on what earnings are actually going to look like next year, because there's a lot of unknowns on the horizon. But suffice it to say, the equities, as it relates to forward expectations, are fairly expensive in relative terms. And conversely, what we've seen here is that dividend yields are down to lows that we have not even seen since the market was really ahead of itself, ahead of the global financial crisis back in 2007, 2008. We've tested this level a few times because we've seen this tremendous run-up in stocks over a multi-year period, but just this latest run-up and the recapturing of those all-time highs by the S&P 500 has driven that dividend yield down significantly to 1.76, which in turn is important for investors that are getting in at this point, that are searching for a return, because we know that 40% more or less of the market returns for investors over the last 40 years or so have been driven by dividends. And so with that dividend yield being low, with overall interest rates being low, the ability for investors that are seeking income is become more difficult to obtain that. And as we have been talking about over a multitude of months here, we've seen a significant divergence in the performance of different parts of the market. So as you can see here, we have been focusing on increasing quality in the portfolios, the quality of the holdings, the quality of the companies in the index. We can clearly see that the companies in the index that have stronger balance sheets are doing much better than the ones that have weaker balance sheets. And what do I mean by that? Just simply companies that have more leverage, more debt on the books, that don't generate as much cash flow, so their capital position's not as strong, those types of things, and don't have as strong a working capital position. That's what I'm talking about here. And this is a Goldman Sachs index, but it can be easily parlayed into the S&P 500. So clearly, higher quality is outperforming lower quality. And this is a cross-section of the S&P 5 sector, S&P 500 sector performance. Obviously, all sectors were down. If you go from February 19th to the low point in the market, which is March 23rd, and you can see energy was down 56%, and most sectors were down, more than 25%. And then since the trough in the market on March 23rd through the 26th of August, obviously we've had a profound 50% rise in the index. You can see that, not too surprisingly, as we've been talking about lately, we've seen a tremendous boost from consumer discretionary, technology, and interestingly enough, materials, industrials, some of the more cyclical type entities have also performed, and those areas are up the most year to date, that being consumer discretionary and technology. This is another chart from CNBC, which it kind of talks a little bit to my previous comments about kind of this lack of breadth. Now we've seen this overall index rise. In the previous chart, we've seen where a lot of the gains have been from technology and healthcare. This chart says that basically from that trough from the peak in the market on February 19th to its all-time high, that we've had 38% of the S&P 500 actually post gains, and then we've had 62% of the index actually post losses. And this is to August 18th, so slightly different date than our previous slide, but nevertheless, it just kind of highlights the fact that, we've had some narrowing in leadership. And so, obviously we want to see, 50% rise, that we want to see more of the index participate in that rise than is clearly depicted here. This is taking us back to consumer confidence, but overlaying the stock market. So this is where you can see that there's a very tight relationship, very high correlation between the S&P 500 index level and the Conference Board Consumer Confidence Index level. And as you might imagine, it dovetailed on the way down here in March, April, but confidence has stayed low while the market has gone up considerably. And that's an interesting and highly unusual deviation over this data series, which just in this graph goes back to 2009. So very interesting observation here. The S&P 500 relative to its 200-day moving average. So, this is basically taking, the last 200 days of the index, creating an average out of that, and then rolling that forward with each successive day. So every day you're just taking an average of the previous 200 days and moving forward. So, usually when the market index level moves up through its 200-day moving average, that's extremely bullish. Actually, we did that not too long ago, but we're now at a point that we're almost as high as we were in 2017 in our in where the index is trading relative to its 200-day moving average, which is actually very, very interesting. It just shows you the tremendous amount of momentum that we've seen in the market as of late. Meanwhile, volatility is measured by, I believe this is a 20-day moving average of volatility. The volatility has just basically been vaporized from the market, where we had a lot of it obviously when the market was going down. We had a lot of it actually when the market was kind of on its upswing, but that volatility level has really, really dropped down, and that's an interesting development. And I think we're at a point now where we could see an increase in volatility off these levels. Just a couple of comments on the relative performance of the U.S. relative to the rest of the world. as you can see here that, this is the MSCI index for the US relative to the minus the MSCI World Index. And what you can see here is that, not too surprisingly, that the US is tremendously outperforming global stocks here, which, they were at parity more or less as of November, and then even through the pandemic, even pre-pandemic, through the pandemic and into this recovery, the stocks here in the US have tremendously outperformed global stocks, and which is one reason why we have de-emphasized global stocks here basically over the last year. Earnings trends. This is a big reason why the U.S. has outperformed. You can see the U.S. in the black. This is the S&P 500 12-month forward earnings expectations, and you can see that relative to 2008, that index level is moving higher. It's now all of these graphs look the same, but the issue here is if you go to DAX, which is in Germany, and the Eurostoxx 50, which is a European index, that both of those are tracking below where they were. So there's much weaker earnings expectations abroad than there is in the U.S., and that's obviously helping to fuel that outperformance by U.S. stocks relative to their global peers. Inflation, quite simply, with Jackson Hole last week, the meetings that the Federal Reserve had, sponsored by the Federal Reserve Bank of Kansas City, basically the Fed has said they're going to let inflation overheat so that they can create kind of an average inflation over time. Obviously, we have not had inflation to speak of here over the last several years, and so they're willing to let inflation kind of overshoot their target, so that the average over a number of years, over a market cycle, is going to be around 2%. And so what that has done is that it is increased inflation expectations, which is defined by this left-hand chart, the 5-year inflation swap rate. So this is just the implied inflation rate. And then correspondingly, on the right is the TIPS yield. And so what this represents is the fact that we have yet another leg down in real interest rates. This is the nominal interest rate less inflation. So as inflation expectations are going up as a result of this Fed stance, the real rates continue to go down, which should help to compress the dollar, probably help exports. It will certainly help emerging markets, and probably help gold as well as a store of value. And in our final slide of the pack here this week, take a look at basically an environmental related data point. And as we spend a lot of time talking about how we're trying as a society to reduce carbon emissions and things like that, you can see that obviously we've made some progress since kind of the peak in this in 2005. But what's really interesting is when you shut down an economy and people are at home and they're not on the roads, they're not driving, using gasoline, in April of 2020, when the economy was shut down, that we have seen, that we witnessed a drop in CO2 emissions below any point that we have seen since dating back to previous to 1973-ish or so. So a pretty profound impact, positively speaking. Obviously not sustainable, because that number will go back up as more months are rolled into this analysis. But it was interesting to see the impact on carbon emissions related to COVID pandemic shutdowns. So we hope you've enjoyed the chart pack of the week. There's a lot of data this week, so appreciate your thoughts, comments, and please see our information here. Feel free to reach out to me anytime. Look forward to seeing you back again next week. And I think we'll probably be a delay today due to Labor Day, but hope you have a wonderful week and be safe.